Hi, I am Anna. I come from www.ntvforex.com. Unprecedented Fed commitment to inflation analysis. http ntvforex.com News ID 309DE8830 2023 31:05 p.m. Unprecedented Fed commitment to inflation. Thursday, August 27, 2020. It may go down in history as the moment when the U.S. Federal Reserve officially committed to a new mandate: greater inequality and more aggressive fiat currency debasement. The new development yesterday is also hugely bullish for gold, silver, commodities, and tangible assets generally. The policy move is likely to weigh on the U.S. dollar, which is ending another negative week slightly below the 92.5 level on the DXY. Chairman Powell's highly anticipated speech at the The Jackson Hole Symposium was not a red light for stocks. Powell announced the Fed will now tolerate inflation levels to rise above their 2% target after years of persistently low inflation. According to Fed officials, a policy adjustment allowing inflation to run hotter is justified by the need to make up for the below-target inflation in recent years. This new twist will also warrant more extreme monetary policy actions from the Fed in their fight to achieve a 2% average inflation rate over time, more QE and rates at zero for longer. How much catch-up is required to reach a 2% average inflation rate? The chart below includes the two main inflation metrics in the U.S., the Consumer Price Index (CPI) and the Fed's preferred PCE, Personal Consumption Expenditures measure. Compare these to the green line, which represents a steady 2% inflation rate since the last recession's official start date according to Federal Reserve data. The green line represents the 2% average where the Fed would like PCE inflation to be. What does this mean for the economy and investors? The Fed has effectively expanded its dual mandate of price stability and maximum employment. Their new tri-mandate is unofficial, but evident through the Fed's actions. Their mandate includes the following: A. Buoy financial asset prices via inflationary monetary debasement. Since the end of 2018, the new mandate is glaring to any dedicated Fed observer. To an average American, the third mandate may not seem too bad at first glance. Inflated 401k values and record highs for equity markets make people feel richer. Future prosperity is being pulled forward in time, giving markets and governments their easy fix, which fulfills an insatiable desire to grow at all costs. In reality, the impacts of central bank-induced inflation and asset price stability are negative for America's future. The following is a brief glimpse of how we've seen the Fed's policy tools drive asset prices higher and higher since the 2008 financial crisis. The wealth gap steadily increased as a result. See the charts below for evidence of what their tools have accomplished so far, then imagine a future where the Fed uses the same tools with even more force. Notice how in the first chart wage growth fails to meet the highs seen in the previous cycle of growth. After 2008, wage growth peaked at record low levels. If the Fed's policy tools helped create a better America, this would not be the case. While wages failed to grow at an impressive rate over the last decade, stocks have shot to the moon, rewarding the wealthy who own financial assets. The Nasdaq is up over 1,000% from its bottom after the 2008 crisis. The S&P 500 is up over 400% during the same period. This is shocking when we compare the 47% increase in employee compensation. These numbers show how much harder it will be for future generations to achieve the same level of prosperity as their elders. To add more perspective, it now takes 128 hours of work for an average wage earner to buy one share of the S&P index. It took less than 40 hours in 1990. Data certainly suggests Federal Reserve actions increased wealth inequality after the GFC, but in 2020, we've seen a whole new extreme. Markets have been obeying the almighty central bank printing press since March with little hesitation. All-time highs for stocks during the worst economic catastrophe in memory. The chart below shows the S&P 500 reacting precisely as the Fed's balance sheet expansion began in March of this year. It seems like the Fed should know better than to deny their policies directly boost asset prices and thus create greater inequality in America. The Fed is promising to use its tools at any cost to force higher inflation and support the markets. Now, ask yourself if the Federal Reserve could not generate enough inflation in the wake of 2008 with $4 trillion in quantitative easing, even larger M2 money supply growth, and asset purchases that defy the original Federal Reserve Act. How much more will they need to do for inflation to run HOTA above 2%? We are about to see desperation from the Federal Reserve and other central banks. Their newly stated inflation goal can be reached by the Fed, but will require many more trillions than the $7 trillion of liabilities already held on their balance sheet. It will also require massive Treasury issuance, on top of the $26 trillion in debt owed by the US government today. Throwing shocking piles of money at the financial markets will increase wealth inequality at a faster rate than we've seen in the past due to the higher levels of unemployment and the law of diminishing marginal returns. I expect this all leads to one of two outcomes: a sovereign default on debt, or a default on fiat currency as a viable system for measuring land, labor, and capital. Either we will continue on the current path until we see powerful G20 nations, possibly including the USA, default on their sovereign debt, or we will go on until fiat money as we know it becomes worthless and in need of a replacement. It may seem like a sad statement, but harsh realities embraced can make way for a more beautiful future. A replacement currency could be backed with real money like gold and silver, or may derive its intrinsic value from the backings of multiple sovereigns like the IMF currency, the special drawing right, or ASDRI. My suggestion is that we now refer to the coming years as the tangible A20s because history has told us only real tangible assets can preserve purchasing power in times like these. Subscribe our channel to receive the news as soon as possible. Thank you for watching. If you want to read real-time news, text messages to MT5 Expert Advisors page at https://m.me/mt5.expert.advisors.